Before I start, I just want to thank the rest of the team who are here today, in particular Wendy, Eva, and Owen for all the contributions, which are really appreciated, putting together what is a huge amount of work in a short space of time. So just wanted to thank them. Okay, so as I said, the economic context for the current commentary is very fast changing, and there's a huge number of changing parameters and contexts for where the Irish economy sees itself. Certainly not where we thought we would be this time last year, or certainly towards the end of last year. We're all very aware of the many headwinds that are being faced internationally. The war in Ukraine has added a dimension to the already high inflationary aspects that were coming out of the pandemic from the broader supply chain issues. And further to that, the degree of uncertainty that has been layered on top of the global geopolitical tensions, which are certainly providing a downward effect on the investment sentiment, certainly, and also providing, we will see some evidence here that it's featuring in terms of households' decisions as well. So certainly a very changing context for where we see the Irish macro economy going. That notwithstanding, we do expect the economy to continue to grow this year. We registered very, very significant growth last year, 13.5%, mainly driven by the export side. And we do expect the economy to grow strongly this year. We're expecting just under 7% GDP growth this year. Now that's going to, in part, as I'll show, that is driven by the continued robust export activity and the very rapid recovery in the labour market. We do expect growth to continue next year as well, just under 5% next year. It's somewhat of a dichotomy at this point, in that we are still expecting the export sector to grow strongly, but we are modifying downwards our expectation for the domestic economy. So relative to our last commentary in March of this year, we are tapering down our modified domestic demand forecast for this year, expecting just under 4.5%, and next year under 4%. That's down, approximately half a percentage point in both contexts. So we a little bit more for next year. So we are seeing some headwinds affecting domestic demand, in particular the persistent increases in inflation. This is likely to be negatively affecting the consumption channel in particular, but also the broader uncertainty due to the war in Ukraine is likely to be affecting the investment outlook. And we're also moving towards a period where central banks are becoming increasingly aggressive in terms of their stance on managing inflation, and they're removing both the asset purchases, but also moving towards a more normalized or increased interest rate policy environment. And that's all weighing on the position we find ourselves at present. So again, Ireland's economy will grow this year. We do expect it to grow this year. We do expect the export sector to be a big contributor to that, particularly the multinational element of the export sector. But we are somewhat moderating our forecasts for the domestic component of the economy, and that's mainly due to the increased uncertainty and just the more persistence in inflation that we've seen. Let me first come to consumption, which is such a large component of the domestic economy. Naturally, we saw a big recovery in the first quarter of this year, and that was natural given the reference quarter of a year ago in the first period of 2021 was a time of quite strict public health restrictions. So we did see the economy continuing its recovery from the withdrawal of the more permanent public health measures, and the abatement of the maintenance of those restrictions in the economy allowed a more normalized activity, certainly on the spending side. Obviously we've documented for a number of commentaries the increase in the savings ratio that happened during the COVID period, and it's natural that demand will rebalance, or certainly attempt to rebalance when households were able to consume those goods and services in a more normalized fashion relative to what they were previous. What I think has changed a little bit for certainly for us is that the price effects really have have taken some of that recovery away in real terms, and that's certainly to a greater degree than we would have naturally expected, before, particular the events around the war in Ukraine and the persistent increase in both commodities and energy prices that came about in that. Following that, I think one of the features that we've documented, or we're trying to document now, and we're certainly observing in the more recent information, is the way in which there's certainly a step change in some of the indicators of consumer confidence and savings since that pinch point in March when the war in Ukraine began. You can see the chart on the right-hand side here. The left-hand side here is a consumer confidence index for Ireland in the green, and the European, the rest of the EU27 in blue. You can see very clearly there was a kind of recovery through 2021, and then there was a kind of moderation towards the end of last year and then into this year as kind of the inflation picked up a little bit. But then you see the very sharp drop in confidence following the war in Ukraine, and in a sense, what we're expecting here is that while some of that speed of the decline may moderate, and not necessarily expecting consumption to follow that path identically, we do see these effects here coming through both the uncertainty channel and the persistently high inflationary channel feeding through to households' decisions. And it's interesting on the right hand side here when we see the savings ratio. What we're seeing here is a persistent decline in households' indications of savings. So while we would naturally think that might feed through into increased consumption, one of the dynamics now of transitioning to a high inflationary environment is that households are finding it more difficult, certainly for particular parts of the income distribution, to save, and those savings may be just being eaten up in price increases. Certainly a very changing context relative to where we found ourselves in the period during the pandemic, and with this inflationary effects kicking in quite strongly. I think one of the things you may notice in the actual commentary itself is we've looked at the savings intentions across different groups of households, because obviously the heterogeneity of where the inflation affects households more is a really important component for understanding these dynamics. And what we're finding is that the higher income households are typically more likely to save in response to the current uncertainty. So that would be what we think about with the precautionary savings channel, and whereas the lower income households are pulling down their savings. So you can see the different effects across different groups of households. In general, though, what the end result is that the outlook for consumption is somewhat more muted than we would have expected before. So certainly we're revising down our consumption outlook. And I think one of the things to point out across all of these forecasts is that we would see most of the risks being on the downside here in the current environment. As I said earlier, the investment channel is also a critical area that's affected by uncertainty. Firms really do take into account the broader outlook when they're trying to make investment decisions, in particular around large capital formation projects, which take many years to accrue the returns on. And all of the effects through both the global trade downturn, the risks around a potential broader based decline in some of the big markets is all pointing towards a moderation in the investment rate. Some of the headline investment forecasts for last year, this year are affected by the multinational activity. So we present the modified investment forecast here, which gives a more granular lens into what's actually happening on the ground in Ireland. We do still expect investment to increase this year and next, but I think many of the effects from the increased uncertainty in the operating environment and the potentially rising interest rate cycle, as well as the increase in business costs and the difficulties in supply chains, are all feeding through into a more moderated investment climate. climate. We still do expect increases relative to last year in the housing market output. So we're expecting 26,000 units for this year, 27,000 units for next year. But we do see risks on the downside there, particularly where the cost of construction and may present challenges to the completions activity in the housing market. So certainly, again, we do feel many of the risks are on the downside there in the housing market. I think it's quite interesting when we look at the sentiment trends. Normally, these are contextualized by some of the active data, such as the retail sales or the production indices on the business side. But when you have such a large shock like the war in Ukraine to the global economy, the sentiment indices can also give a really interesting lens into what's happening. So it's very useful to give them weight in the present context. And what we can see here very clearly is that across all sectors, so these data are the business sentiment trends from the European Commission, so it kind of looks at what firms view as the potential outlook for going forward. And you can see across all of the sectors here, there has been a marked downturn in Ireland in the grades of industries, services, retail and construction since the beginning of the year, particularly since March of this year. So you can see it's broad-based, it's cross-sectoral, and all of these trends are kind of moderating at the outlook. And particularly quite interesting to see the sharp downturn in the outlook for the construction sector reported by construction firms. I think that's quite notable in the context of the broader EU figures there, which don't see that. So I think that's a useful indicator of the potential challenges and downside risks to the activity in that particular sector. On the traded side, again, Ireland here is in a very unique position with the very strong FDI component of the export sector. And indeed, one of the features, again, that we always remark on, but we continue to remark on, is that in the first quarter of this year, the multinational activities, in particular the computer services, the pharmaceutical activities, all were growing strongly again in the first quarter of this year. And in a sense, we've actually raised our outlook for exports for this year on the back of those data. So these activities appear to be resilient in the face of these global challenges. That doesn't necessarily mean it'll all continue to be the case, but certainly at present, it appears that we will post strong export numbers again this year. And that is on the back of the very strong increase in particular in those multinational dominated sectors. And I'm not necessarily talking about some of the more globalization effects like contract manufacturing. This is in the real goods and services like computer services, like pharmaceuticals that are produced in Ireland. So certainly this is an increase in the kind of traditional real export activities of these multinationals. We are expecting the import channel to increase as well, both in line somewhat with the relative to last year, somewhat with the consumption recovery, but also with the export recovery. So we will see imports increasing, and our outlook is clear on that. I think obviously one of the aspects of the current climate that is adding to the uncertainty is the position in relation to Brexit and the ongoing difficulties around the Northern Ireland Protocol and the potential for trade-related fallout from that process. When we're considering our forecast, I think it is important to be mindful of these. Naturally, with the strength of the FDI-related sector, I think it's many of the FDI-related exports in particular are going to be the drivers of the broad export activity, but that doesn't mean that there aren't going to be sector-specific risks that may materialize for particular sectors that are exposed to Brexit. And I think one of the features which we're documenting here and in the commentary, which is notable, is that the share of Irish trade, in particular with the UK, excluding Northern Ireland, has dropped quite notably over the period since 2005, since the Brexit activity. So the pre-Brexit activity. So you know, these difficulties in the trading environment may cause sector-specific effects and may be considerably problematic. Again, for businesses operating in this environment. So finally, just talking through the labour market before I hand over to Kieran. I think, you know, the domestic recovery can be clearly seen in the labour market context. You know, we are moving to a period now where, you know, on a monthly basis, we're sub 5% in the unemployment rate. And, you know, our forecast for this year is that we'll hit that 5% for the full year period, and then to drop to 4% next year. I think it's very clear we're going to be operating at full capacity or full employment in the labour market, you know, in the very near future, if we're not there already. And naturally, you know, where we are with the inflationary context, the risk there in a very tight labour market is that, you know, you have prices rising, wages rising, and therefore you can have the development of potential feedback loops between the rising wage rates and the inflation rate. So certainly we're getting to a position in the Irish economy now where we are operating at that capacity constraint in the labour market, and therefore, you know, we have a very strong labour market, very robust labour market, but certainly one that there's very little slack to take up any additional economic activity that happens, and normally in those circumstances that'll feed through into wage rates. I think, you know, it's very notable to look at the unemployment rate and see the trajectory, and, you know, in a sense we've you know, they come back fully from the pandemic. We're now at the level we were just prior to the pandemic. So you can see the stark improvement in the labour market. So at that point, thank you for listening, and I'll hand you over to Kieran to talk through the rest of the material.
Great. Thanks very much, Conor, and good morning to everybody. Let me just share my screen there. Sorry there. So yeah, so along with the
Kieran, sorry, yeah, could you just put that in presenter mode?
Sure, there we go. Is that okay?
Thank you.
Okay, so along with the usual fare in the commentary, we have a series of boxes looking at issues around forecasting wage rates in the economy, given its importance in the present context. Also some work on inflation and on the impact of interest rate increases on Irish house prices. So the first box, as I say, we look at forecasting wage rates in the economy, given the importance of wage rates in the context of inflation more generally. And we take a relatively standard approach, which has been taken in the literature before. It's basically estimating a form of Phillips curve, where we look at the wage rate in the context of previous developments in the wage rate and the relationship between the actual unemployment rate and what's called the NAIRU, which is a kind of a non-accelerating inflation rate of unemployment. And you look at the relationship between those two unemployment rates, and that has a major impact on wages. Using the model, it suggests that wage growth this year will be somewhere in the region of 3.5%. and then 4.5% in 2023. However, what we would point out, as Conor noted, about how tight the labour market is getting, and our forecast, obviously, of 4% unemployment next year. What history does show is that once the unemployment rate falls below 4%, wages really begin to take off in the Irish economy. So you have this kind of what we call a non-linear effect, whereby the pace of growth of wages tends to accelerate, particularly when the unemployment rate falls below 4%, because 4% historically is a very, very low rate of unemployment in the Irish context. On the public finances front, we still see very strong increases in government revenues and the various different exchequer items, so income tax, corporation tax, VAT, excise duty. Obviously, the corporation tax at the end of this month, June, is particularly important, and November. But even so, for the year to year, you're still seeing very, very strong growth across all the major tax headings. We have the expenditure is running a little bit behind the target expenditure outlined at the start of the year. And we do build in our public finances estimates, we do build in the contingency fund of around 3.5, just over 3.5 billion. Which is built into the Exchequer figures for this year to deal with the Ukrainian crisis. And that's essentially carrying over some of that contingency funding which was put in place for the pandemic some years ago. So we have factored that into our analysis, and overall because of the strong pace of growth on the revenue side, we see the public finances registering, a modest surplus this year of 0.3% of GDP, and then growing next year to 0.6% of GDP. But again, a lot depends on the extent of the contingency fund, whether, of course, that contingency fund has been set in place for the Ukrainian crisis, but of course the government and the Exchequer may draw on it in terms of additional measures to do with the cost of living, for instance, if they wished to do that. So there is some funding, quite a bit of funding set aside for contingency issues. And as I said, that leads us to be relatively optimistic in terms of our forecasts on the public finance front, in terms of there being a surplus this year and next year. Obviously, inflation is a hugely important issue at the present time, and we've done quite a bit of work in the commentary looking at it, in particular diving down into the various different components of inflation in terms of what's driving inflation, but also looking at the distributional impact. And it's quite clear that if you look at the distributional impact across households, particularly by income decile, it's obvious that households in the lower income deciles are being confronted by a relatively higher pace of inflation than the average household, and certainly than households at the upper end of the income distribution. It's also worth noticing that rural households appear to be impacted more or face a slightly higher pace of inflation. Of course, that's probably due to the fact that transport costs are a particularly strong contributor to inflation at present because of the whole issue around energy and energy prices. So, as I said, some interesting stats there in terms of the distributional impact of inflation. Also, in terms of looking at how broader based the inflation rate is becoming. And so if you strip out the energy and food items, you can see that, for instance, the most recent data would suggest that the increase in the CPI, excluding all energy products, was 4.7% in May of 2020. May of 2022, the present year. So that just shows that even when you strip out energy, which is a major component of CPI developments in the last while, you can see that the inflation rate more broadly is becoming, or the higher inflation rate is becoming more broad across more and more goods and services in the economy. And that does highlight the risk of domestic factors beginning to feature in the inflationary process in Ireland. So up until now, a lot of the commentary is focused on the external contribution to inflation as far as the Irish economy is concerned, and in terms of energy and food items. But it's clear that the inflationary pressures are now spreading and broadening out, if you like, across the economy. And of course, that has a connotation in terms of the persistence of the inflation rate. Another box that we have in the commentary looks at the pass-through effect of international inflationary pressures into domestic prices. And so Conor and Wendy in particular did a lot of work looking at inflationary pressures as per the IMF global forecast. The IMF has forecasts of different components of inflation along the lines of there, if you see food, electricity, gas, liquid fuels, etc. And you can see the IMF forecasts are very substantial in terms of what they're forecasting over the coming period of time. So really very, very large inflation rates. What we do is compare the inflation rate over time in an Irish context with those global items. And what we see is there isn't a kind of a one-for-one pass-through. So we don't see a one-to-one pass-through of those global inflationary pressures into the Irish context, but you're still seeing very substantial and strong growth in those items in the domestic economy. And again, that just goes to show how significant the inflationary issue and inflationary pressures are at present. The third box we put together is one which is looking at the impact of the potential impact of the ECB policy rates on Irish house prices. So this is in the context of the kind of announced essentially 50 basis point increase in the policy rate. and how that will affect the Irish property market. So clearly one of the issues that you have to look at in this context is how much of that 50 basis points increase in the policy rate is going to manifest itself in terms of the actual rate faced by Irish consumers and Irish households. That depends on how many of those households are on variable rates, how many are on trackers. Obviously the fixed rates won't be impacted in the short run. And so a lot depends on the pass-through of Irish financial institutions and how they pass through any increase in the policy rate. So we do, we put a model of house prices together, one which incorporates in the effective interest rates, and then we simulate that model for the higher policy rate and also at a given pass-through. So we assume a certain pass-through based on previous work, and all of that suggests that house prices, everything else being constant, and of course, that's the crucial factor here, that Irish house prices would be 2% lower because of the 50 basis point increase. Now, that's purely on the basis of the interest rate. We're not saying that house prices are going to fall due to the interest rate increase. There are other factors clearly which will come into play. The strong demand side pressures which are still there in terms of income levels and the labour market, and the fact that we still have the relatively sluggish response on the supply side of the market. But when you just isolate the effect of the interest rate on its own, that would lead to a fall in house prices of 2% due to that 50 basis point increase. So we also have our risk section in which we outline some of the potential risks. And obviously, as Conor has suggested, the risks are very much on the downside as far as the outlook is concerned. Clearly, the war in the Ukraine is still ongoing. And, it's still very difficult to predict what the short to medium term implications of the conflict are going to be in terms of their further impact on energy prices and on food prices, and the extent to which that is going to influence global inflationary pressures, and of course then the knock-on effect for our own domestic inflationary pressures of those. But also, of course, the response now of policymakers. So given that you are seeing a tightening of monetary policy, particularly at the ECB, but also the US and the UK, this is throwing up its own risks. And particularly, you look at the way in which the sovereign debt market has been responding over the last couple of months, particularly if you look at Italian bond yields and German bond yields, which we've shown there. Clearly, you see an increase in the spread, and obviously that's something that has been concerning ECB policymakers, given the particularly high level of Italian debt at around running at around 150% of GDP. So clearly, a significant increase in funding costs is something which is of concern, and something, particularly in the context of the ECB trying to dampen the general inflation rate. This is clearly a risk going forward, and a risk which obviously they will seek to manage. So obviously overall then, in terms of the assessment, there are a lot of downside pressures. We still have the ongoing uncertainty around how long the inflationary pressures are going to continue. Added uncertainty from more general uncertainty in terms of the war in the Ukraine, the knock-on effect that will have on particularly investment and even consumption decisions for households and firms. But notwithstanding all that, we still believe that the economy is going to grow this year. As Conor said at the outset, a lot of that growth will come in terms of the headline GDP figure will come from the export market and the performance, particularly of the multinational sector here. The modified domestic demand, which looks at the more kind of indigenous or domestic sources of growth, we have reduced that down relative to what we thought the last time, but we still see significant enough growth there for modified domestic demand at just under 4.5% this year and over 3.5% next year. So the economy is still expected to grow, even aside from the multinational side of the economy. But in conclusion, the downside risks that are there are quite significant, and particularly, I suppose, concerning inflationary pressures and other uncertainty tied to the war in the Ukraine. So with that, very happy to take any questions that people have.